Markets are celebrating the ceasefire. Oil is down, panic has cooled, and investors finally have a reason to breathe. On the surface, this looks like one of those moments when geopolitical risk suddenly backs away from the edge and gives markets room to recover. But the real macro question is much bigger than whether today's headline feels better than yesterday's. The real question is whether this ceasefire actually changes the deeper risk structure underneath oil, inflation, rates, and investor confidence, or whether markets are simply buying temporary relief before the next repricing begins. Reuters and AP both describe the current ceasefire as temporary and fragile, while the Strait of Hormuz remains one of the most sensitive energy choke points in the world. Welcome to Vale Macro. This channel is about decoding the real economic meaning behind major events, political signals, and market-moving headlines. The goal is not just to repeat the news. The goal is to understand what the news may actually be changing underneath. And this story matters because it captures one of the most important ideas in macro investing. Markets often react first to a reduction in immediate danger, even when the bigger structure of risk remains unresolved. That is exactly what may be happening here. The ceasefire matters because it lowers the immediate probability of a full-scale energy shock. That part is real. If missiles stop, if escalation pauses, and if shipping through Hormuz looks safer, even temporarily, then the worst-case scenario becomes less urgent. Markets respond to that very quickly. Reuters reported that oil prices fell sharply after the ceasefire news, while risk sentiment improved across other assets. AP also described the market move as a relief response to a pause in immediate escalation. So the relief trade is not imaginary. It is based on a real repricing of short-term risk. But that is only the first layer of the story. The second layer is whether this is actual stabilization or simply delayed instability. This is where macro analysis becomes more useful than headline analysis. A temporary ceasefire can reduce the fear premium in oil. It can improve short-term confidence. It can help markets step back from the most aggressive disaster scenarios. But none of that automatically means the underlying geopolitical problem has been solved. Markets may price a lower chance of immediate disruption, while still leaving a meaningful premium on future instability. That is why this moment should not be read as a clean, problem-solved event. It should be read as a test of how much risk has really been removed and how much has only been postponed. And that distinction matters because the Strait of Hormuz still sits near the center of the story. Reuters has emphasized that energy markets remain in a kind of uncertain holding pattern, not a true all-clear, because Hormuz remains central to global oil flows, and because a fragile pause is not the same as durable security. In practical terms, that means markets may feel relief today, while still remaining one serious headline away from repricing the entire situation again. That is the first thing markets may be missing. They may be treating a reduction in immediate danger as if it were a reduction in structural danger. Sometimes those are the same thing. Very often they are not. This is why the oil market remains the first and most important signal to watch. If the ceasefire is real enough to lower near-term shipping risk and reduce the probability of disruption through Hormuz, then crude can stay softer than it otherwise would have been. That is the straightforward relief trade. But if you see oil stabilize only briefly and then begin to regain strength, that would suggest something important. It would suggest that the market does not fully trust the political pause. In that sense, oil is not just reacting to the ceasefire. Oil is voting on the credibility of the ceasefire. And once oil enters the conversation, inflation enters the conversation almost immediately. This is the next layer many investors underestimate. Energy is not just another part of the market. It is one of the fastest channels through which geopolitics enters the broader economy. If oil rises, it moves into freight. It moves into shipping. It moves into industrial input costs. It moves into transportation. It moves into airline costs, trucking costs, logistics, and eventually consumer prices. So if the ceasefire truly lowers the chance of an oil shock, that matters not just for traders, but for inflation-sensitive assets and for central bank thinking. Reuters has also reported that policymakers are increasingly sensitive to geopolitical shocks because they can push inflation pressure back into the system through energy and supply channels. That means the ceasefire is not just a foreign policy development. It is also an inflation development. If crude stays calmer, inflation risk becomes less intense at the margin. That does not mean inflation suddenly disappears. It does not mean all other price pressures vanish. It does not mean central banks can relax immediately. But it does reduce one important upside risk. And in a world where central banks have already been struggling to balance slowing growth against still sensitive inflation, the removal of even one major risk input matters. This brings us directly to rates. Markets do not price future rate cuts in isolation. They price them against the path of inflation, the path of growth, and the path of stability. If the ceasefire lowers energy risk and helps keep oil under control, then the argument for eventual easing becomes easier to defend. But if the ceasefire fails, if oil rebounds, or if markets begin believing the risk has only been delayed, then the argument for rapid easing weakens again. In other words, this ceasefire can affect not only geopolitical expectations, but monetary policy expectations as well. And once monetary policy expectations shift, every major asset class feels it. This is why a temporary ceasefire can create a short-term rally without creating long-term clarity. That point is critical because in markets, relief and resolution are not the same thing. A relief rally can be real, it can be tradable, it can be powerful, but it can still be fragile if it rests on political conditions that the market does not fully trust. This is where a lot of investors get into trouble. They see a better headline, assume the worst is over, and chase risk before the deeper structure has actually improved. The market may go higher for a while, but if the foundation under that move is weak, the reversal can come much faster than people expect. That is why this video is not really about whether the ceasefire is good or bad. It is about whether the market is pricing the right thing. So let's break down what markets may be missing. First, they may be underestimating how fragile the ceasefire really is. AP and Reuters both characterize it as a temporary framework rather than a durable geopolitical settlement. That means the probability of future disruption may still be much higher than a clean relief rally would suggest. Second, markets may be too quick to assume that a softer oil price immediately means a safer inflation path. It might, but only if the energy calm actually lasts. If the pause breaks down and crude spikes again, inflation risk can come back much faster than broader narratives adjust. Third, investors may be underpricing the importance of cross-asset confirmation. A rally in equities alone is not enough. If equities move higher, but oil starts climbing back, the dollar stays strong, and yields do not confirm relief, that is a warning sign. It tells you that the market may be reacting emotionally to the headline before the deeper macro signals have aligned. And that is exactly why the asset layer matters so much here. Start with oil. Oil is the cleanest and fastest read on whether the market believes immediate disruption risk has really gone down. A durable cooling in oil tells you confidence in the political pause is improving. A rebound in oil tells you the market is still pricing future instability. Then watch the dollar. In stress episodes, the dollar often strengthens because investors move toward liquidity and relative safety. If fear truly fades, the dollar should lose at least some of that defensive support. But if the dollar stays firm, that could be a clue that the broader system still feels unstable underneath the calmer headline. Then watch gold. Gold becomes less urgent when panic falls, but it does not automatically become irrelevant. If the ceasefire is viewed as fragile, gold can remain supported beneath the surface. A sharp and sustained drop in gold would suggest that fear is being unwound more decisively. Resilience in gold would suggest that investors still want protection. Then watch bonds. Bonds are more complicated because they are balancing inflation and growth at the same time. If investors see the ceasefire as reducing energy-driven inflation risk, yields may ease. But if they see the ceasefire as too weak to change the bigger inflation picture, bonds may remain cautious. This is why yields are such an important signal. They tell you whether the bond market is interpreting the story as inflation relief, growth relief, or neither. Finally, watch equities, but do not watch them alone. Equities usually like de-escalation in short term. A ceasefire lowers immediate tail risk. It lowers the chance of a sudden energy spike. It helps calm fear. That can support risk appetite. But equities also need clarity, and clarity is exactly what a temporary ceasefire does not yet provide. So if stocks rally while the rest of the macro signals remain unconvincing, that may not be a clean bullish message. It may just be a relief move running ahead of the deeper evidence. This brings us to the investment layer. For investors, the biggest mistake now would be to confuse short-term relief with long-term reset. If you're holding cash, patience still matters. The ceasefire may reduce immediate panic, but does not guarantee a stable macro backdrop. Cash remains valuable when uncertainty remains unresolved because it gives you optionality, and optionality matters in a market that may still be one geopolitical headline away from another repricing. If you're holding equities, the key question is not simply whether markets bounce. The key question is what kind of bounce this is. Is it a broad re-rating based on real macro risk reduction? Or is it a relief rally built on a temporary pause? The answer will show up in oil, yields, the dollar, and cross-asset behavior. If those signals confirm lower risk, then the equity move has stronger foundations. If they do not, then the rally may be thinner than it looks. If you care about gold, the message is more nuanced. A ceasefire can weaken the most extreme fear trade, but does not automatically destroy the case for protection. Gold becomes less urgent when panic falls, but remains relevant when the deeper system still feels unstable. So gold investors should not just watch the ceasefire headline. They should watch whether trust is actually being rebuilt underneath. If you focus on bonds or other rate-sensitive assets, this story feeds directly into the inflation and policy debate. A calmer energy backdrop gives markets more room to believe in eventual easing. A renewed energy scare takes that room away. So this is not only a foreign policy story, it is a rate story, and rates still sit close to the center of the pricing system. So what should investors watch next? The first signal is oil, not just whether it drops on the first headline, but whether it stays calmer over time. The second signal is inflation expectations and rate cut probabilities. If energy fears fade and markets become more comfortable with future easing, that supports a broader relief narrative. If those expectations barely improve, the market may be telling you that the ceasefire is not enough to change the bigger macro outlook. The third signal is the dollar. If fear truly fades, the dollar should lose some of its safety premium. If it remains firm, investors may still be pricing unresolved instability. The fourth signal is gold. If gold falls sharply and stays weak, that suggests fear is being unwound more decisively. If gold remains resilient, protection is still in demand. The fifth and most important signal is whether the ceasefire remains verbal or becomes durable. Markets can price relief off words, but they need more than words to price long-term stability. That is the difference between a political pause and a macro reset. There is also a broader lesson here that fits the whole mission of this channel. Politics does not just influence markets through policy that is already enacted. Politics influences markets through changing expectations. One change in tone can affect oil. Oil can affect inflation. Inflation can affect rates. Rates can affect valuations, housing, currencies, and investor behavior. Once you understand that chain, these stories stop looking like isolated headlines and start looking like connected macro events. That is exactly how today's story should be understood. The market may be pricing relief today, but the real question is whether it is pricing real stability or just delayed instability. That is the question behind oil. That is the question behind inflation. That is the question behind rates. And that is the question behind whether investors should lean back into risk or stay cautious a little longer. So yes, the ceasefire matters, but the deeper point is not the ceasefire headline itself. The deeper point is what that headline changes in the market's map of the future. If it changes that map enough, capital moves. And when capital moves, the effects spread far beyond one conflict, one region, or one trading session. For investors, this is not just a ceasefire story. It is a test of whether political de-escalation is strong enough to change the macro outlook or only soft enough to delay the next shock. If you want daily breakdowns that connect politics, macro, assets, and investment risk in one clear framework, subscribe to Vale Macro. This channel is not about repeating the news. It is about decoding what the news may actually be changing underneath. And if you want, leave a comment below telling me what you want next. Oil, inflation, the Fed, gold, the dollar, or bonds. I'll see you in the next one. Welcome to Vale Macro. This channel is about decoding the real economic meaning behind major events, political signals, and market-moving headlines. The goal is not just to repeat the news. The goal is to understand what the news may actually be changing underneath. And this story matters because it captures one of the most important ideas in macro investing. Markets often react first to a reduction in immediate danger, even when the bigger structure of risk remains unresolved. If you want daily breakdowns that connect politics, macro, assets, and investment risk in one clear framework, subscribe to Vale Macro. This channel is not about repeating the news. It is about decoding what the news may actually be changing underneath. And if you want, leave a comment below telling me what you want next. Oil, inflation, the Fed, gold, the dollar, or bonds. I'll see you in the next one.